Hi, everyone. Nice to see all of you already showing up. 121 of you uh, viewing. We've got Clive coming on a little later, and we might have a special surprise guest. We've had him on before, just once. We'll see if he can make it. The title today of the live stream is "The End of the LBMA Paper Scheme Will Make Gold Great Again." So we'll look into that topic. And yes, it's been almost a month since I reported a story from the FT about the fact that the Bank of England had a delay of 4 to 8 weeks to deliver spot gold, and it hasn't gotten any better. And when I reported it on my channel back in on that day, I've got over 110,000 views on that video. I said that it was the most significant story about the gold market since Gordon Brown pre-announced the sale of half of the UK's gold, and I think it still is. And this story is still evolving. And at the time, gold was at 2,760, and we're almost $200 higher. And personally, I think it's just beginning. This Yeah, I think the LBMA and even the COMEX to some extent, they're being exposed for what they are. And I've said it here many times that they're bucket shops basically. They don't really trade real physical gold and silver. And when there is some demand, like we're seeing now, which really isn't overwhelming, they can't really deliver. So that's what we're going to look at. And we're going to look at other things as well. Not just that, we're going to answer your questions as well. And we have some questions that Clive got on LinkedIn as well that we're going to answer. So we've got 424 of you already here. So I'm just gonna quickly try to say hello to most of you. We got Bradley Rutledge from Oldsmar, Florida, Darren Smith, Pablo Pina, Mark Sneed, Daryl Ruffley, Hio Silvers were here, Don Stewart. There's so many of you now. It's great. I mean, to see the channel growing as it is. It's difficult to keep up with it, but I'll try my best. Mark is here, says hi, Mario, and everyone. Jake's Custom Parts is an old follower, long time follower, I mean. Pablo Pina as well, very long time follower. Dutch Libertarian, hi, Dutch Libertarian. Belly Dance Arabia as well, been here for a long time. Jay, Timothy Whittington, uh, here. Quite a few of you. Hugh Jones says, hi, Mario. Pete Dutoit from South Africa. Endurorama, longtime follower too. Michael Kennedy. Hi, Michael. Quadman72. Hi, Quadman. I haven't missed you. Alan Satoshi Greenspan. All right. Jonas Carlson. I guess you're from Sweden. Hi, Jonas. Nick Banfield. Hannah. Yeah, I did play golf today, Hannah. It wasn't the best weather. It was quite windy and cold, but we had a good match, four of us. Yeah, good. It's just nice being out playing golf. We started around 8 o'clock, so early golf. Stacy Roderick from Central Illinois. If I miss uh, any of you, it's not personal. It's just that it's going through very quickly, the chat. Hi Ho Silver, Frenzied 1976 from New Zealand, Eddie Sadler, RB, hi RB, Rizard Molenda, hi Rizard, hope I pronounced that correctly. Hello, Mario. Thanks for all your videos. Just wondering, do you need to store gold and silver in a special way to stop it from deteriorating? No, no, Helen. That's why gold and silver are money. They gold doesn't. I mean, silver does tarnish a bit, but gold doesn't tarnish at all. You can leave it for thousands of years, and it will still be nice and shiny. Silver, not so much. But yeah, it doesn't really matter. You can leave your gold underwater for for eternity, for an eternity, and it will still be nice and shiny. It doesn't rot. It doesn't corrode. Nothing happens to it. Nor silver. It just tarnishes silver, but you shouldn't really clean your old silver coins. Leave them as they are, I would say. Brian Kuntz is here. Alan P. from Texas. Scott Lynn, Sun City, Arizona. It's always great to see people from all over the planet. Martin van Pomelen, he's from in Canada, even though sounds like a Dutch name. Kroike says, hello, Mario and Rudy. Yeah, Rudy is here today. R. Elkus says, looking good. You all keep breathing exercises. Phil Ward. Hello, Mario. As these rates of delivery, how much longer do you estimate before LBMA run out? Um, I'm not sure. They're gonna run out of actual physical gold. The problem now is that they've lent them out many times over, so they're in default. So I think what's gonna happen, they're gonna scour the planet for physical gold, and it's gonna drive the price higher. And LBMA is the bullion banks, and the Bank of England is like allied with them. They're gonna do their, you know, they're gonna do everything not to call it a default. I think the way it will be played out is in a massive short squeeze of the price. That's how it's going to be. We'll see what Clive thinks, and hopefully we're going to get a special guest coming tonight. The only problem the only reason why he might not make it is because it's very early or late where he is. Christine Masso, good evening, Mara. Greetings from windy Scotland. Yeah, it's been pretty windy here down in the south of England too. Rose Prouty from Illinois. Phil Ward from Buckinghamshire. So let's see. Yeah, I can hear the wind outside. It's really blowing right now. So I think who's here? Oh, the special guest has been able to make it. Um, King Kong from Hong Kong. Um, Eric Young. Hi, Eric.
Hi Mario,
Nice to
how
see
are you
you.
doing today? Nice to see you again.
Yeah, yeah. I'm glad you were able to stay up.
Yeah, I'll never miss your show, Mario.
Oh,
There you have it.
thank you. We're still waiting for Clive. We've got a couple of
Okay.
minutes. I usually start a little earlier. So the I always try to give the live stream a title, and this one is the end of the LBMA paper scheme will make gold great again. So
Wow.
Yeah, I guess that make something great again is quite popular these days with the MAGA. But my view is that the LBMA and even the COMEX to some extent, they've been basically manipulating the the price of gold for decades. And with what's happening now in the LBMA, with I think I don't know, you might know better. 40, 4 to 8 weeks to deliver spot. I think they are, for all intents and purposes, in default. What do you think, Eric?
I think you're correct. I think I don't think they ever admitted it publicly, but Reuters did a report on them at the end. I think it was January 29th, and they said that the LBMA gold contracts are basically now at 48 weeks.
Yeah,
48 weeks, that's like a month to 2 months. So that's like T plus 30 to T plus 60, right? In my opinion, that's an indicator that like if you go on the LBMA website, it says that they have 8,500 metric tons of physical gold,
mm,
approximately, at their vaults. Well, now that we know that they cannot deliver physical gold until 4 to 8 weeks later after being requested, Mario, do you think they have 8,500 or thousand like 8,500 tons of physical gold at the vaults?
well,
Is that like a believable number? Let's say I'm talking about unallocated, right? Okay,
yeah,
unallocated gold that they have access to. Do you think they share a vault with the Bank of England?
yeah.
Okay, so do they have un? I Yeah, I'm just gonna let you answer. Do you think they have it? Eight
Well, you
thousand five
mean
hundred
unallocated 8,000.
unallocated. Yep,
Yeah, no,
unallocated.
I don't think they do. It's mostly paper promises. And Eric,
Yeah.
I saw this story on January 29th, and I think I was one of the first to. I even made a second video, which I don't during the day, to cover this. And I've just gone back to look at it, and you can see here gold stockpiling January 29th. And I can tell you they've changed the story because
Oh, they did.
they've
Wow.
taken out the part where it says that it takes 4 to 8 weeks to deliver. I can't see it anymore. I mean, you can see it in my video, but they've changed the story. I've gone through the article, and there's nothing about the 4 to 8 weeks. So,
Wow.
yeah,
But you know what? You know what, Mario? If you take the link of the original article, I don't think they changed the link. It's probably the same. If you put that into Grok AI,
yeah,
Grok AI will give you a summary, and it'll say the
yeah,
48 weeks.
yeah,
They'll take the original, like whatever they wrote originally, right? The
yeah,
algorithm, and they'll spit that out to you. I have a screenshot of that.
yeah,
But either way, again, it's probably at the request of the LBMA that they
yeah.
are compelled to change it. I mean, have you seen that news about the LBMA saying that they might have to do something to Bullion Star because Bullion Star is saying some,
Oh,
you
yeah.
know,
They
truth
they
about the LBMA, right?
Yeah,
Yeah,
they told them, oh, whenever you write something about us, send it to us first so we can verify it, which is,
yeah.
I would never do that.
Well,
Uh,
do you want to run like, do like a run through of what the heck is going on at the
yeah,
like at the LBMA and at the COMEX because you know it's pretty much one system, right? Like
yeah.
connected by the EFP mechanism,
Oh, yeah.
So I can explain that to your
Yeah.
audience. You want me to do that?
Yeah, just a second because I'm we're waiting for Clive, and
Okay.
I'm looking for my tweet on 29th. I'm going back
Okay.
here on X because I've got that that post, that FT story, and I highlighted the 4 to 8 weeks. It's just that it's so much stuff here. But you know, EFP, I always I also remember when I worked as a futures and options broker, a lot of times people did EFPs, but it was just a paper thing. People most
Yep.
people think it's real physical, but it's not. But now, like you know, when you're gonna explain it, what's going on, but hold on a
Yeah.
sec.
I'm gonna explain it.
Yeah,
I'm
yeah,
gonna do it
yeah.
right now.
I'm just trying
Yeah.
to get
Okay.
just to show it to people that I'm not BSing or anything. It's just so many pretty active on X. So there's a lot of stuff. Let's go. Come on. And I got, you know, my X account isn't that huge, but I got a lot of likes on that, like thousands of likes, which is unusual for me. Hold on.
Nice.
Hold on. 30th. Almost there. Anyway, let's see if Clive is here. Oh yeah, he's here. Let's admit Clive. And then we can let's say hello to Clive and then uh, we can go on about the EFP.
EFP. Yeah. The exchange for physical,
Ah,
which is a misleading name, by the way.
yeah.
Misleading name.
Oh yeah,
Yes.
they mislead everyone. Hi,
Yeah.
Clive.
Yeah.
Good evening, Mario.
Hi, we've got Eric Young or AKA King Kong with us today.
Wow.
Hi. Good afternoon, Clive.
Good evening, Eric. I did we've
Yes.
ever spoken before, but I did actually see a video with you. I think it was today. I recognize you from the gorilla face. Very hard to miss, you know. And I saw a video, I think it was today, where you were talking about the gold deliveries and so forth. I thought that was a rather good one.
Oh, thank you. Thank you, Clive.
He's
Glad
going
you
to
enjoyed it.
explain that to us and the viewers, Clive. Oh, I wanted to show Eric and also the viewers because I went back to the article. This was from the 29th when they broke out the story about the LBMA, and now I went back to the story and they've changed the story. They've taken out this part of the weight to withdraw bullion stored in the Bank of England's vaults has risen from a few days to between 4 and 8 weeks. So they've taken that out, Clive, but it's here. So
Hmm.
the title today, Clive, is let's see. The end of the LBMA paper scheme will make gold great again. Eric wants to explain what happens between LBMA and COMEX and the EFP. So we'll give him the floor right now, and then we'll go over to you, Clive.
Great. Well, I'm
Okay.
fascinated to hear from you, Eric. You did explain extremely well when I listened to the video this morning on another channel. So go ahead. I'm all willing to listen to it again. That's great.
Okay. Thank you, Clive. Thank you, Mario.
You're welcome.
So be
Just
okay.
a
So
second, Eric. There's
yes.
just wanted to thank Jake's custom part for his super chat, and he says, "Welcome, King Kong." Uh,
Jake.
he says, "You're the best, bro."
Thank you, Jake. Thank you, Jake.
Okay.
Okay. Okay. So what happened in the past with the COMEX and LBMA is that a lot of these bullion bank players would um, take their basically what they would do is they would short the COMEX and they would long the LBMA. Okay, so it's two paper contracts that they hold simultaneously at the same time, and what we call that the EFP trading pair. Okay, so one short at the COMEX contract and one long at the LBMA, and they make money by that arbitrage. So everything is fine as long as the LBMA cash contract is slightly more than the COMEX contract. Okay, so I usually use a model of $99 for the COMEX contract and 99.50 for the LBMA contract. So you make 50 cents, right? And you are shorting the COMEX contract and long the LBMA contract. And then you just simply cash settle, right? So that's what happened in the past. But what happened in the beginning of December, starting in the beginning of December, is that there was a huge or a lot of huge buyers of physical gold at the COMEX. So that pushed up the price of the COMEX contract to a point where basically there's no arbitrage anymore. These players are losing money. There was as you know, we were just talking about that, Mario. There's a shortage of physical metals at the LBMA. So it went from T+2 or T+4 to T+30 to T+60. And when that started to happen, the cash contract at the LBMA became basically a forwards contract. It's no longer a spot contract. So it traded at a discount. So now we went from 99.50 to something like $96. So these guys are losing $3, right? Okay, because the COMEX contract is still at 99 or maybe even more, right?
Yeah.
Okay. So that happened. So when that happened, what do these contract holders do? What kind of options do they have? Well, if they exercise the paper contracts, they lose money. They don't want to do that. So what they do is they stand in line to take the physical delivery of the metal, and then they deliver it to the COMEX. That's what they are trying to do. And that's why you see that huge influx of physical metal to the COMEX. Michael Lynch used data from the COMEX, and he compiled, I believe, it's a 674 metric tons of physical gold that the COMEX imported since early December. Now, Reuters actually came out with a report as well. I believe also, was also at the end of January that they came out with this report, and they estimated that the LBMA shipped out 400 metric tons of physical gold to the COMEX. So if you add another 20 days on top of that, I think it's safe to say that most of the gold that the COMEX received are from the LBMA.
Yeah.
In the last 2.5 months, let's say, right?
Yeah.
So yeah, going back to our story. They're delivering gold. All this data is showing you that the gold is coming from the LBMA to the COMEX. So what happens, let's say, for the players who are not able to get physical gold? Well, they are compelled to close the short position at the COMEX. They have to. So they're losing money on the reverse arbitrage now. On top of that, they have to buy a spot contract at the COMEX to close that short. So it's like I call it robbing Peter to pay Paul in terms of physical gold, right? You're basically giving dumping the problem on somebody else. But of course, you're losing money in that process, right? You're short covering.
Yeah.
So that would propel the gold price higher. That's why, we see gold price going up sometimes during this period, and then they slam down, but they won't slam down too much. And I believe that's because there's still gold coming in from the LBMA, so not everybody is needing to short cover but when they do short cover, it spikes
Yeah.
the gold price. So it's still relatively under control.
Yeah.
So
And
that's yeah. Sorry, go ahead,
no, go
Mario.
ahead, finish.
Yeah.
Sorry.
Yes. So I'm just saying, that's what I call the EFP doom loop,
Yeah.
because at the end of the day, right? The price goes up, or if it just even stay at this current level, I'm talking about the price at the COMEX, right?
Yeah.
And this situation at the LBMA persists,
Yeah.
where, you know, let's say in 30 days or 60 days, there's no gold. They need to push it out even further to 90 days. Then your paper promissory note futures contract at that's paper now, pure paper at the LBMA, is going to even have a bigger discount. You
Yeah.
you see how it's a doom loop, right?
Yeah. And
More demand push. Yeah, sorry. Go ahead.
this has happened because someone basically kind of destroyed the game in between COMEX and LBMA through the EFP. Is that because someone big is buying real physical?
Yeah, that's the original. I think the root. I call it the root cause. Is
Yeah.
someone big at the COMEX
Yeah.
buying a lot of physical gold. It's not tariffs. I mean, that's an accelerator, but it's not the root cause. The root cause, I mean, let's put it this way, right? This started in the beginning of December. The tariffs weren't even announced in the
No.
beginning of December. That was just Donald Trump got elected.
Yeah.
Okay. So my thesis, my guess is that once Donald Trump got elected, Scott Bessent talked to Janet Yellen and Jay Powell, and this process started
Yeah.
of asking all the U.S. bullion banks to assist the U.S. government to repatriate gold back
Mm,
to the U.S.
yeah.
So that's my thesis.
Okay. So
And yeah,
look,
so anyway, so this process is going on right now, and basically, I don't see an end to this.
yeah,
I
I
see,
guess it opened a can
yeah,
of worms on the in this EFP mechanism.
yes,
And
and
someone asked, sorry, um, Eric, before you came on, when will the LBMA default? But I said they can keep this game going, and the way to hide the default is just to search for physical around the world to satisfy the deliveries. But all that will do is drive the price a lot higher. That's the way I see it.
yeah. So Ronan Manny made a good point. He said, if this is not the U.S. government behind the scenes doing this, why would they go through the COMEX and like basically implode the EFP mechanism for everybody to see? This is almost like a public execution of the LBMA,
Yeah,
because without that COMEX LBMA T plus 60 T plus 30 connection, we as outsiders we don't know what's going on. I'm just going by actual facts
yeah.
to deduce that this is happening.
Mm. So
Um,
just
so I think Ron and Manny is correct on
yeah.
that point.
So
Yeah.
Eric, just wanted to ask Clive what he thinks about that. And I think Clive, we had some questions that you got on LinkedIn that were related to that. So I'll bring them up here.
Well,
Yeah,
I'd like to just come back
yeah,
to what Eric has been saying and expand on that a little bit.
yeah,
So, in London, people are normally, they keep their gold in London. Why? Because they can lend it out and earn a decent rate of interest through the London Bullion Market Association. And they never expect to have to deliver on the COMEX futures, which they've shorted, because traditionally they get the short at COMEX, the future reaches maturity, they roll it over and keep doing that. However, they're fully hedged because they have gold in London, and if the worst comes to the worst, they can, in normal times, arrange for the gold in London, which is 400 ounce bars, to be shipped to New York, converted to 200 ounce bars, and within a couple of days, they've got it ready and waiting in New York to be delivered in the very unlikely event that they have to deliver gold because something's gone awry with the gold market. Now, obviously, something did go awry with the gold market, and these New York futures were trading at such a price that it made sense to deliver to New York from London. So they're ordering the gold bars to come over to New York, and they're not arriving, or at least there's a large delay. So, what are as Eric said, what are the options for the futures trader to do? He's short of New York. He's got basically broadly speaking, if he can't get his hands on the gold from London, he's only got one option. He has to close the spot future, the current month, by buying it back, and simultaneously sell the future month to stay exactly where he was. I effectively remained short, but as the spot month has arrived at that maturity, he's got to buy it back. In other words, pushing up the spot price and sell the future. But now, in normal times, you'd expect the arbitrage between spot and future, if he's doing that, to the gap to narrow. In other words, you'd expect the future price to trade at a smaller premium to the spot price as he does that. But that's not actually happening. What we're actually seeing is, despite these people, those who are rolling their contracts, we're seeing that the futures price is trading at a premium to spot, which is very unusual. It's unusually high. So not only is the spot price rising, but the futures price is rising even more than the spot price. So we now have a larger than ever gap between the futures and the spot. And what does that tell me? It tells me that someone is out there, which is basically what Eric was saying, acquiring the gold. Whether they're taking delivery of the spot or rolling or taking delivery in the future by buying the futures, net, someone is buying the futures faster than the spot is maturing, or faster than people buy the spot. So the gap between spot prices and future prices has become very large, or much larger than usual. I calculated it's still like 14% annualized a couple of days ago. Now, that's an obvious arbitrage for any bullion bank who can lay their hands on 100 ounce bars in New York. If they can lay their hands on 100 bars, they'd buy the 100 ounce bars in the futures market, a spot, and effectively sell the futures and arbitrage, make 6 to 14, depending on the arbitrage level, make 6 to 14% annualized by selling the future, a risk-free trade. But that would normally, and it always has done in the past, bring the prices between the spot and the future in New York back to normal levels, where the difference between the two is no more than what's called the cost of carry, i.e., as far as gold is concerned, the cost of carry is the interest rate between the futures maturity date and the spot future maturity, i.e., today. But that level has gone to unusual rates. So someone out there is actually taking delivery of the gold and also in the futures market buying up the futures, and we don't know who that person is. So Eric and Mario, who do you say it could be?
Clive, so I'm going to give you some additional data. I was talking to Ron and Manny, and he provided two articles to me. One is from Global X. Global X is, said that the U.S. imported 2,000 metric tons of gold since the beginning of December 2024. And 2 days later, Bullion Vault, as you probably know, Kai, is a LBMA member, confirmed that news. 2,000 metric tons of physical gold imported into the US in the last 2.5 months. So what does that mean? That's a lot of gold, okay?
Yeah.
In 2.5 months. What does that mean? That means that whatever we see in the COMEX is only 1/3 of the gold that the US imported. And that's in line with what we know about the gold market, right? Most central banks when they import gold, I'm talking about foreign central banks, right? They would do it pretty discreetly. They do it between central banks to central banks, or they do it OTC. So as outsiders, we never really hear about that. We don't that data is pretty opaque. We don't see that. So that to me, like that's a huge number in 2.5 months. That to me is another indicator showing me that this time, this physical gold that is being imported into the US is by a price insensitive player, a big player that is price sensitive.
Yeah.
And to me,
central
that
banks are
yeah,
central banks are completely price sensitive because they can print the money ad infinitum, so they don't care what price they pay.
yeah,
Yeah.
exactly. So that, like in my opinion, my humble opinion, these are Fed proxies, or Fed, or like U.S. Treasury proxies that are doing this.
Yeah.
I mean, if you look at the loadout of the import, um, James Anderson, he shared a loadout sheet with me for the last 26 days of bullion banks that imported physical gold into the COMEX vaults and the receivers. I mean, it's the unusual suspects. It's HSBC, JP Morgan, Morgan Stanley, Standard Chartered, Bank of America. Okay, I have that list. And I believe that the U.S. bullion banks are under the instruction of the U.S. government to either assist the U.S. Treasury or the Fed to import this gold into the U.S. And of course, maybe some of these bullion banks are doing it for their own books as well. Why not? If you're doing, let's say, 1,500 tons of gold for Uncle Sam, maybe you're doing 300 tons for your own books. You're a bullion bank, U.S. bullion bank, and then maybe you're doing 100 tons or 200 tons for your clients.
Yeah, Eric,
So
and
that's yeah, yeah,
these these bullion banks, a lot of times they front run. They can front run a little bit to make money because they know that more is coming from the treasury, and it's not a really a regulated market. Just wanted to interrupt you a second because we've got a super chat from CB. Thank you, CB. Um, and he asks, or she, "Hi Mario, how safe do you think Poland's gold reserves are held in the UK? Do you think they're rushing to repatriate it?" Well, I'll answer that first, and I'll let Clive and then Eric answer. I don't think any gold at the Bank of England is safe, to be honest, especially with what's going on. Uh, and what might happen is if Poland wants to repatriate it now, they're going to have to wait a very long time. So, for all intents and purposes, yeah, Poland's gold for now, in my opinion, is yeah, it's not there de facto. Clive, what do you think about Poland's gold?
The reason for keeping gold in the Bank of England in London is in the event of an invasion by an enemy territory, you have some gold out of their reach. So, for example, in the Second World War, if Germany invaded Poland and some of Poland's gold had been in London, Germany would be able to seize the gold at the Central Bank of Poland in Poland as they invaded, but they wouldn't be able to access the gold in London, and therefore that would still be available for buying weapons and so forth to defend themselves. So it does make sense for a foreign central bank to keep gold in London, but it also makes sense to have it back in your home country in the event that you fear that your gold in London might be frozen in weaponization of money by the USA or by sanctions or something else. So the question is, to what extent do you want to get the balance between the two locations, or maybe three locations, because you might want to keep some in New York and some in London and some in Poland. Um, obviously, given the way that things have gone with sanctions and weaponization of the dollar and so forth, the uh, the tendency of central banks will be to bring more of their gold home. And so I think that logically, any bank any country who holds gold in London will be shipping some of that gold, but I don't think they'll ship it all. They'll ship some of it back to their home country and have less in London because they fear the sanctions might, at some future date, in some future circumstances, bite them. So yes, I think gold is coming home from the Bank of England to other countries, and it would be very advisable for them to do so.
Eric, maybe you
Okay.
can also talk. I don't know if you saw that clip
Yeah.
about the Australian senator saying that the Australian gold bars had been sold off and they had new bars.
Okay, so I'm going to say that I don't want to be the bearer of bad news. Mario probably know what I'm going to say already. But basically, if you have gold at the Bank of England, if you're a foreign central bank, I would be really, really worried. Why do I say that? Even if your gold is allocated, okay, I think all the first of all, I think all the unallocated gold is already gone, shipped out already.
Can you
If your
explain to
gold,
the viewers that
yes,
what allocate unallocated is?
okay.
You said it they
So
it's all gone, right? Yeah.
yeah, so my understanding of unallocated gold, I'm just layman, like simplify it for people, right? Unallocated is that let's say you have a contract with a foreign bank, and the Bank of England is the custodian of your gold at the Bank of England vaults, and that physical gold is collateral. Your contract, let's say, says that in 10 years you can repatriate your gold, but all they guarantee you is that you get the same purity and the weight of gold back. So that's unallocated. It means that they can lease it a million times. They can rehypothecate that gold a million times. They can do whatever as long as um, at that after at the maturity of that contract, they give you the same purity and weight of gold back. So that's unallocated. But as you can see, if that's the case, that gold is all gone at the Bank of England vaults because of the current situation with the short supply of physical gold.
You said
Now,
that the Bank of
yes,
England has 8,000 tons on that.
8,500.
Is that in
And
the
that's
LBMA?
LBMA said that they have that in the votes.
Yeah,
But as
because
we
the
all
bank,
know,
yeah,
the Bank
sorry,
of England is the custodian for that,
yeah,
right?
just
So
sorry,
yeah,
Eric, just to clarify as well, the Bank of England itself holds, I
yes.
think, 5,300 or thereabouts. I think that's the allocated for other central banks, or it's a bit confusing, but the total, I guess, like you said, is 8,300 unallocated.
Yeah, something like that. It's
Yeah.
something 8,000 something, right? But
And it's 400
um
tons.
they didn't say it's unallocated or allocated. They
Yeah,
just said they have the LBMA just said they have around 8,500 metric
yeah.
tons. It's on the website. So but I'm assuming that if they're not lying, those are all allocated because they shipped out all the unallocated already. Um, because right now their spot contract is T plus 30, T plus 60, which means they have no access to immediate gold. I know the excuse is that they have to resmelt it, relabel it, whatever, but that's not believable in my opinion.
Yeah.
So they either lied or about their holdings or is allocated. But either way, there's a very disturbing piece of news that came out from Bloomberg. Um, I guess it was 2 weeks ago, right around when the news broke out from Reuters saying that the Bank of England, sorry, the LBMA no longer can do T plus two or T plus four delivery, and it was about basically the LBMA asking LBMA sellers of gold to go to foreign central banks and ask them to lease gold to them
Boy.
so that they can sell it at the LBMA to fulfill their contracts. Now, why is that disturbing? Because, like you said, the Bank of England or the LBMA vaults are holding foreign central banks' gold, like Clive said. So, are they saying, is Bloomberg basically saying that the LBMA is asking its members to somehow ask these central banks to lend them that gold? And I said this in another show. These LBMA members, some of them are bullion banks, right? Probably a lot of them are bullion banks. They probably have connections with the IMF, or they themselves might have lent money to these foreign countries. If that's the case, are they leaning on these foreign countries to compel them to release that physical gold at the LBMA vaults, which is under the Bank of England custodianship, to be released to the LBMA so that they can ship it to the US?
Yeah, that's a very good.
Yeah, I mean that's a big danger, right? If you're a foreign country
They
taking the
could
gold.
basically threaten these countries if you
Yeah,
don't lend us the gold, we're gonna, we won't roll over your loans through the
yeah.
IMF. Just wanted to thank Chris Conman for his super chat. He's asking if gold is revalued to current levels, would that be considered the floor for it? Would it then start to naturally move higher? Thanks. I'll answer that first, and then I'll let Clive and then Eric. And he's talking about the statutory price of 42.22. That was raised from 38 in 1973 in the US. And I've looked at the charts, Eric and Clive, when they raised it from 35 to 38, and then from 38 to 42.22. In those 2 years, gold went from, around 40, 45, and it took off to 200 in a matter of a couple of years. Well, 1 year, by end of 74, it was at 200. So that's what I think would happen. Yeah, even though uh, Scott Bessent, the Secretary of the Treasury, he didn't sound very convincing. He said, "No, we don't think, we're not thinking of revaluing it." So, Clive, I'll let you answer first.
Well, first of all, the United States has revalued the statutory price of gold 4 times historically. The most recent one, I think, being in 1972. And each time they did this, they were able to book a large profit, thus reducing the deficit, which obviously helps the level of US debt. Um, in a certain sense. Now, if they were to revalue it this time to $31,110.35, and I'll get back to why that figure might be an appropriate figure. So let's assume they revalue it to $31,110.35 this time around. That would become the new floor for the gold price because everybody and anybody would know that they're able to sell gold to the US Treasury at that price
Is
or
that
to the US Mint.
3,150, you said, Clive?
Yeah, $3,110.35. How do I get to that, Mario?
Oh,
Can
yeah.
you spot that one? I think you know how I get to that, maybe.
Maybe some ratio with
Okay, so that how many grams of
oh
gold
yeah,
are that?
31.1035.
Yeah, so that would basically be putting the price of gold to 100 US dollars per gram.
Yeah, 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 that's right.
That's why I get to that figure. So it's a bit of a fictitious figure because we don't know what they'll revalue it to if they do indeed it. But if they do, the Treasury is there, and or the Mint is standing ready to buy unlimited amounts of gold at that price. Of course, they're not going to sell it to you at that price because they want to acquire as much gold as they possibly can. But what that does, it puts a floor under under the price. So who in their right mind is going to sell their gold for less than $31,110.35? Nobody, because they're going to say, I can't lose money by buying it. So they're going to buy it and they're going to push the price to a price which is higher than the floor. So if they do decide to monetize gold, i.e., with a new statutory price, the gold will always trade at a higher price than the statutory price.
Yeah. Eric, what do you think about revaluation?
Well, I agree with Clive's explanation of why the revalued price will be the new floor of gold, of the gold price, right? That makes sense. But I've heard this from Judy Shelton and also a ex Fed banker through one of my followers. And both of these people are telling me that the US government, if they are to revalue gold from $44.22, is actually 44.2222.
Well,
If
42,
they
22, I think.
40 $44.22, 22.
Oh,
So like four decimals, right?
yeah.
44, 22, 22. But if they are to revalue it, they would revalue it mark to market. So that's what Judy Shelton said, and that's what the other person said. The the ex Fed banker
Yeah.
said.
That would
Why
definitely,
why is that? Why
yeah.
is that? Like, like you might like your audience might ask me that question. Why do mark to market? Why don't they do the $31,000 that Clive just talked about? Why? Right? Well, Clive pretty much answered the question because at $31,000, everybody in the universe will ship their gold to the US, or a lot of people. Maybe not everyone, right? But a lot of people because the US government will defend $31,000
I think
per
30,
troy ounce of, yeah,
Clive said 3,100.
Yeah,
3,100.
yeah,
Oh, okay.
$3,110. Yeah.
Sorry, Clive. Okay, that makes a lot more sense, right? Like because that will probably be the mark to market price at that point when
Yeah.
they actually get to doing it.
Yeah.
So that makes sense. So I think at 3,100, and let's say we get there in a couple months, right? It makes sense. Why? Because then the physical gold flows internationally will be neutral. What I mean by that is it's not going to change much from what is going on right now, other than the fact that the US is repatriating a lot of gold, right? I'm talking about before that happened. So it'll be a neutral situation where the U.S. Treasury do not need to defend the new price of gold
Yeah.
if you market the market, right? And then once that happens, what like what will happen? Because the US government is basically sending a very strong signal saying that physical gold is remonetized into the system. What I believe will happen then is that the free market would revalue physical gold a lot higher. Now, that's great, but what's a prerequisite of that? For the free market to efficiently revalue gold a lot higher, you have to break the LBMA for that to happen.
Yeah.
And that's happening now, right? So I think, what will eventually break the LBMA, in my humble opinion, is that piece of paper at the LBMA, that promissory note, at some point it's going to be in a huge discount. It's going to be in such a big discount that the entire world will see that basically that piece of paper is fake. You're not going to be able to get your gold in a reasonable, timely manner.
Yeah. And it's
Yeah.
interesting, the 3,100, Clive. I saw a week or two ago, Goldman Sachs, they forecast that gold would hit 3,100 in 2025, which isn't really a great, it's easy to, they're not going out on a limb because we're so cl fairly close to there. But we've got another super chat here, which is interesting, Eric, because you've spoken about this. Shelley Dow, thank you for the super chat. Can you please explain what this means for the GLD ETF and Sprott Physical Gold Trust? Thank you. Yeah, it- yeah, I'm
It's a good
gonna
one.
show this. I'm gonna bring this up. You tweeted something quite funny about this. Here we go. This is what the GLD is.
In them dire hills. Well, back with another one, eh? And how about a couple of carrots for this rock here? Of course. Keep the change, Doc.
So can you explain that to Shelley?
Absolutely. So the GLD, in my opinion, I wrote this today, is basically a piggy bank for the authorized participants, and most of these guys are bullion banks. For them to milk physical gold from just regular retail GLD investors. I mean, it's happening right now in front of our eyes. Why do I say that? It's because look at the GLD borrowing rates right now. It went from, I believe, 3 point or 6.5% to 8.5% recently. I know it dropped, but it fluctuates basically, the borrowing rate. The bottom line is it's really high. Why is that? Because a lot of bullion banks or APs, they are borrowing GLD shares so that they can redeem it. What I mean by that is once they borrow the shares, they redeem it for physical gold. They withdraw the physical gold out of GLD. So what is happening right now with the GLD gold votes is that it's fluctuating between 800 metric tons and 900 metric tons. Okay, whereas back in 2020, 21, I believe it exceeded 1,000 metric tons. Why did it exceed 1,000 metric tons back then when the COMEX votes had similar, levels of import compared to now? Whereas right now it's just bouncing between 800 and 900 metric tons. The reason is because every time retail investors buy GLD and GLD APs buy new physical gold to deposit into GLD, there are these bullion bank APs who are borrowing GLD shares to redeem physical gold. So you see how my piggy bank analogy makes sense? Is exactly what is happening.
Yeah, and it's really, I mean, the small mom and pop or even fairly big investors, they never take delivery of GLD because there's a limit of 10,000 shares. I mean, it's designed, these ETFs are designed to really service the bullion banks. And that's why I've always told people that don't go, if you really want to invest in physical gold and silver, you need to do the real thing, not GLD and SLV. Clive, have you got a view on this?
Well, we have net redemptions from the US ETFs and others. And that tells me that first of all, the public is not participating in the gold market at all at the moment. And as Eric says, those net redemptions could be happening because we have big players who want to take delivery, and we don't know exactly who that big player is, but it's all part of the game. So if you have a lot of shares in the GLD ETF or one of the other ETFs, you can convert those shares back into physical gold, and somebody somewhere is actually doing that. It's not the man in the street, but someone's doing it. So the total amount of gold in the ETFs is going down as that gold is being redeemed and someone taking delivery of it. Where is it going to? We don't know.
Yeah.
So that's my goal. I just want to sort of touch on a couple of things which Eric and you have said. First of all, the video about the Australian politicians questioning what's happening to their gold. Um, the answer, there was a politician saying, "Where's our gold? Why isn't the Bank of England giving it to us?" or words to that effect. And he pointed out that the on inspection or some sort of check that the gold bars had the serial numbers had changed on the gold bars. And the response from the Australian finance minister was basically, yes, that's normal because what we do, although we have our gold deposited in London, the Bank of England or whoever, LBMA, whoever's got it, is lending it out on our behalf. So they don't, when we lend out gold, they don't actually have to return gold with the exact same numbers on the bars. So this is a normal reason that the bars wouldn't necessarily be the same number that we get back. We lend $100, we get back $100, but the serial number on that note has changed. The same thing for the gold bar. But what does this show to us? It means that a lot of the gold, which is actually held by other central banks, is lent out. Why do they lend out? Because they can earn a nice 3 to 6% a year by lending it out in gold, and it's a nice little earner. So the question, if you've got deposit in London, why wouldn't you authorize the LBMA to lend it out for you? It seems perfect. I mean, that's how they've been thinking up until now. But of course, the problem we've got now, or potentially we've got, is they lent it out, and maybe the LBMA can't get it back to deliver when Australia or whoever it is wants their gold back. That I think is the point
Yeah.
which is being made.
And Clive, I listened to that, and the cent whoever answered the politician, I don't know if he was from the central bank or the treasury, said, "Well, the gold never moves. The gold doesn't move." But my question to that guy would be, if the gold doesn't move, why do we get new uh, serial numbers? It means that the gold moved out of the Bank of England and went somewhere else. But anyway, what I wanted to touch upon now is WikiLeaks, and you might think, What are you going on about?" Well, as a lot of you know, the gold ownership was banned in 1933 by FDR, Executive Order 6102. And then on January 1st, 1975, it was made legal again. And there was a London wholesale gold dealers' view on U.S. gold sale and private U.S. ownership. So this was like communication between, let's see, the U.S. Treasury and the bullion market in London about what to do. Because did you know that the gold contract on COMEX, uh, it was started trading, GC started trading on 31st of December 1974, because the settlement would be on the 1st of December and would be legal. And these people are talking about how they can keep the public in the US disinterested in acquiring physical gold, because yeah, they didn't want them to be too involved. So the US Treasury was in contact with the, well, it wasn't called LBMA back then, but it was the bullion market. And this is really interesting, Eric and Clive. This is what it says here. To the dealers, and the dealers are in London, expectations will be the formation of a sizable gold futures market. Each of the dealers expressed the belief that the futures market would be of significant proportion and physical trading would be minuscule by comparison. Also expressed was the expectation that large volume futures dealing would create a highly volatile market. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term hoarding by U.S. citizens. So you can see that for 50 years, the COMEX and the London bullion market, they've been conspiring to keep U.S. citizens from hoarding gold. And I'm not too much into not prophecies, but like jubilees and things. But it's interesting that this happened exactly 50 years ago, and now we're seeing this scheme seems to be uh, falling apart. So, Eric, I'd like to your opinion on that.
Well, um, I look at it in this perspective. I just think they can't kick the can down the road anymore.
Yeah.
I think Donald Trump came in with Besant, and they looked at the numbers and they figure, something has to be done. And they are going to be the adults who are going to get it done. Have you? Yeah, sorry, go ahead.
Go on, Eric. Eric, I thought you'd finish. You carry on.
Yeah, I was just going to say that I was listening to Jim Bianco. I mentioned this fellow several times. He's now, being quoted by Bloomberg about the zero coupon century bonds. That he's saying that the Trump administration is going to force upon U.S. allies. So what that is basically you have all these U.S. allies with holding a lot of U.S. Treasury bonds that pay a decent yield. And who is paying that yield to these U.S. allies? Is the U.S. government. I mean, there's so much money. It's almost $1 trillion of interest payments per year. It's more money that they're spending now on their defense budget. So to cut that down, they're going to force U.S. allies to convert a large part of those U.S. Treasury bonds that they hold to these century bonds, zero coupon century bonds that zero coupon, so they have no yield.
Yeah, it could be also 50-year bonds they're talking about.
50, yeah, because I talked to Jim afterwards, and then Jim said, yeah, it can be 50 years. And then I also asked Jim, I said, why would it's not even, I can't even conceive anybody going for it, because if you're paying the principal back in fiat US dollars in 50 years, whoever agreed to convert their regular US Treasury bonds, let's say with 2% yield to this zero coupon bond, is going to lose their shirt because of
Eric,
inflation
sorry,
over 50 years.
just to
Yeah.
clarify, I read,
Yeah.
I think you read Good as Gold as well, Judy Shelton's book. I don't know, but yeah, they're zero coupon bonds, but they've got like a call option on it. So when you buy the bond, if gold's at 3,000 and then in 50 years it's at 25,000, you can actually take delivery of the gold.
Yes, Mario.
Yeah,
Yes. I was
and
getting to that because Jim wasn't talking about the gold components. So
oh,
that's what happened. I told him, I explained what you just said about
oh
what
yeah,
Judy proposed. And
yeah,
Jim said, yeah, that makes sense. So
yeah,
I think that's what they're doing. Like they can't screw over their allies too much. Otherwise, it'll become a political fiasco.
yeah.
So what I do think is that Judy's proposal is probably going to be picked up by Trump, and this is what they're going to do. So it all makes sense. Why Donald Trump is talking about auditing Fort Knox, and I guess there's a lot of hints in the financial sector in the U.S. talking about gold revaluation, because those two things have to happen before Judy Shelton or Scott Bessent launch these U.S. Treasury gold bonds in 2026.
Yeah. Clive,
So that's it.
you wanted to
So,
comment?
yeah, my comment actually concerns this concept of which I think Eric just mentioned, zero coupon perpetual bonds. Now, when I was a younger man, and we're talking many decades ago, working in finance, and we used to joke with the new employees that could they go out and find us a zero coupon perpetual bond. And that was a big joke because there's no such thing as a zero coupon perpetual bond, because if it's perpetual, you're never going to get paid back. And if it's zero coupon, you never get any interest.
Basically,
But
like fiat cash.
but exactly. But what my point is here, there are millions and millions of people all around the world who do, in fact, unknown to them, hold zero coupon perpetual bonds, something which is so daft that if they were asked whether they'd buy it, they'd say no, yet they're holding pound notes or dollar bills which pay zero and have a perpetual life, i.e., you'll never get repaid in anything tangible. So that was my comment on zero coupon perpetual. No company anywhere in their right mind or individual is going to change their money for zero coupon perpetual unless you intend and believe that you could get rid of it within a few weeks or days of getting hold of it, which is obviously what we're talking about, cash. So you're taking cash, believing you could dispose of it before it comes worthless. The second thing I wanted to say was something about the what was written back 50 years ago about having a futures market, meaning that it would make gold a lot more volatile, and that would mean that people would be discouraged from buying gold. Well, I can tell you from my career that the minute something has a price which changes, it doesn't actually matter tuppence halfpenny whether it's really worth anything. Buyers and sellers will appear for something which changes in price a lot. And the faster it changes in price, the more it changes in price, the more attractive it becomes to speculators. So I could stand on a beach offering to sell all of you blue stones. I could put a sign up saying, I'll sell you blue stones for $10 and buy them back for $9. And people look at me and say, Clive, you're crazy. Who's going to buy blue stones? But I've got all the blue stones and nobody wants them. Next day, I put a sign up saying, I buy blue stones for $12 and I sell them for $11. And someone's saying, well, you're crazy. We'd sell you some, but we don't have any. We didn't buy any yesterday. And the week after I put them up and say, buy at 6, sell at 5. And the week after I put it up and say, buy at 25 and sell at 24. And sooner or later, some idiot is going to come along and say, this Clive Thompson, he's a complete idiot. He's changing his price all the time. I can take advantage of that. I'll buy some blue stones off him. And next time he puts the price up, I'll sell them back to him and make a nice profit. So volatility on its own creates a desire to own it. That's why people go to the horse races. The human race loves a gamble. We're hardwired like that. And this is why stocks and so on are quite often trading way above what they're worth, because people think they can buy in the morning and sell in the afternoon. They think they can outsmart everybody else. That's their belief. And that's why we have in times of speculation like we have at the moment, stocks on Wall Street, which are trading way beyond what they're really worth.
So you think they did that so that people wouldn't be interested in just holding the gold, but they wanted to just trade it so they wouldn't buy the physical?
I think they got the wrong end of the stick. Obviously, the minute they have something changing price, there's going to be people who want to hold the futures, which actually means people want to hold the physical as well. I just say how wrong could they have been?
Yeah, it looks like it might have taken 50 years to ruin that scheme. But we're kind of out of time. We usually do this for an hour. So before we finish, just wanted to ask Eric and then you, Clive. So what would you be doing right now, Eric? I know you're a stacker. We can see there you've got loads of bars. What would you be doing with your gold right now, or would you be adding to your gold pile? Yeah.
I'll be holding all my physical gold, a lot of it. And in terms of adding, I've been adding over the years, Mario. You probably know that. Every time I buy a new piece of gold, I show you guys.
Yeah, yeah.
So maybe I'll buy some more. It's possible.
Yeah,
But I think right now, I was just gonna say right now, I think physical silver is a better deal. Because I've been trying to buy more physical silver because I think $32 or 33 is just a ridiculously low price for physical silver, in my opinion. It's a better buy, if you ask me, in this juncture.
Yeah, I agree with you. I agree. Clive?
Well, Mario, I've been buying gold and silver within, actually, I'm going to say recent days. I'm a net long. I have no intention of selling any. I'd stay that way. I know we're running out of time, Mario, but if I could just butt in a little bit. We talked on Friday about who might be the major buyer of gold. Of course, we're speculating it might be the Treasury. We also said, what if it's Warren Buffett? That was a bit of speculation. Now, I looked into whether Warren Buffett is widely reputed as being disinterested in gold and silver, but I looked into it and I found, when I looked into it, that back in 1999, 1998, I think it was, Warren Buffett and Berkshire Hathaway bought up 20% of all the silver on the planet. And that's there in their annual report for all to look at. So obviously there are times when he has moved away from paper money, and but we know he's hoarding a lot of paper money. But today we had the Berkshire Hathaway annual report released and the letter from Warren Buffett, and I just want to read you a paragraph from that letter and let everybody draw their own conclusion. And this is what Warren Buffett said in today's letter. Paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual. And in our country, that's the United States, in our country's short history, the US has come close to the edge. Fixed coupon bonds, I repeat this, fixed coupon bonds provide no protection against a runaway currency. So he is already sounding the warning in this year's letter.
Yeah. And can you hear me?
Yep.
Yeah, so it wouldn't surprise me. I'm not saying he's been involved in buying all this gold that's going to the States, but he could start buying himself. And can you imagine what that would do? So with that, we're gonna end because I think Eric needs to go to bed. Uh, and I'm gonna
Thank you, Aaron.
thank Eric. Yeah, thank you very much for coming on. It's always great to have you, and you as well, Clive, and all the viewers that came on the live stream as well. Thank you very much, and I'll talk to you later. Take care,
Thank you,
guys.
Mario.
So good
Thank
night, Eric. Must be 4 o'clock in the morning for you, Eric. Am I right?
you. It's 5 a.m. actually.
Wow.
Clive.